Bookkeeping is the Bookkeeping is the regular process of recording, sorting, and storing a business's financial transactions. Is it the same as accounting? No, but the two are related. In my Accounting Basics video, I said that bookkeeping was one of the many branches of accounting, but it's really the trunk of the accounting tree. Why? Because accurate record keeping is the foundation to doing your taxes, building financial statements, making business decisions, and spotting mistakes.
Can you see the chain, from bookkeeping to accounting to tax consultants to auditors, so it shows you the role you play. Next slide, please. So bookkeeping is more like, putting your records together, gathering your data. You see it as gathering financial data. Data comes in different forms, finance and non-finance, But see your records as the data you need to put in place to gain, to extract insights, to help you to make the right decisions and help your business to grow. And it's simple, it's just in keeping your income, noting your income, tracking your expenses, your assets, and your liability. And the question we get in most cases is, how do you know all these things? How do you put these things into different buckets? How do you understand what should go into income, what should go into expenses? Some people struggle with those things. And you can't blame them because they are non-accountant, they don't have finance background. So it shouldn't be an indictment, right? But if you can do 2 + 2, and you can add 2 + 2 together to get 4, then you can do bookkeeping. It's as simple as that. If you can add 5 + 5 to get 10, you don't need to do the math yourself. You don't even need to do the computation or generate report. There are softwares, accounting software that would help you achieve all these things. And that's why we're saying all you have to do is just to keep your record, right? You can, depending on the stage where your business is at, you can pay for subscription accounting, or you can use spreadsheets, which is the most easiest. If you have a laptop, you can use spreadsheet. Even if you don't have, yes, go back to the conventional method. Start writing things down, Keep records in your book. Open a particular sheet. Okay, this is where I'll be recording all the sales I make. This is where I'll be recording all the people that I'm owing. This is where I'll keep the list of all my assets and all. So that is what bookkeeping is all about. Next slide, please. So it's important to touch on key elements of the financial statement. And in accounting, this is what it's all about. We have 5 buckets to communicate your financial information: your revenue, your expense, your capital, your assets, and your liabilities. This is what financial accounting, financial reporting, call it anything. This is the foundation. This is the bedrock. Like the basic that you need to know. Just pick that financial statement. This is what they are trying to communicate. And this is what helps you to make all the decisions you need to make about your business. But how do you get here? It's by keeping your records, like we said. So what is your revenue? In simple terms, it's just your income. You can call it different names. So people get confused when they hear the word turnover, when they hear all those words. Maybe it's more relatable when you say your income for this particular period. What is your income? Then your expense. What are your expense? They are simply the cost you have incurred in getting in the ordinary course of your business. So if you are a caterer, or if you're into catering business, how much have you spent on getting your raw materials? If you're in fashion business, how much have you spent on the people working with you, the fabrics you bought, even as things like advertisements and all those things. That is what your expense represents, and cost as well. Then there is another bucket that talks about, or that communicates your equity, that communicates your capital. That is another bucket. That's another element of a financial statement. And what is it? It's talking about the amount that you have invested in your business, either by the people that have invested in you, or the money you have raised to start your business. If you borrow the loan from bank, it's not really an equity to you. It's more like a liability to what you're doing. So then we have the assets, which are all the resources that you're deploying to generate that revenue or income, as the case may be. They can be a short-term asset, or they can be a long-term, which is called another non-current asset. When you're talking about short-term assets, you're talking about assets that you can consume, say, in 12 months. Accounting cycle is usually 12 months, 12 months or maybe a little bit more. That's what is classified or categorized as your current asset. That's where you'll be having things like, just name a business here that we can give examples. So I want this class to be interactive. I've been speaking, I've not been engaging my audiences. So just name a business and let's pick an asset that we can use as a current asset. It's business. What would be your current asset? Okay.
That's a sewing machine.
So she's into fashion business. Your sewing machine would actually be your non-current asset, because you've been using your sewing machine for how long now? 2 years. So it's usually for things like that, they are classified under PPE, maybe your property, plant, equipment category. So because you can use it for more than 2 years, for more than a year, going to like 4 years, that's like a non-current asset to you. And usually what we do in accounting is you depreciate that asset. Say you bought it for 5 million in 2023. The standard, in most cases, and it varies, right? Depends on the industry you operate. It's usually like 4 years for assets in that category. For 4 years, so you start depreciating that assets for that number of years. So a sewing machine to you is a non-current asset. Things that you can call a current asset is like your fabrics that you bought. Say, for instance, you want to make a suit for me and you bought fabrics and things like that. Because you are consuming that materials, it's an asset to you. It's an inventory to you because you bought it, right? If I said, okay, I'm not doing this with you again, you can look for TWT or someone else to make the suit for. But because you can consume it in that space of, say, less than 12 months, it's an inventory and it becomes a current asset to you. So those are the assets that you look at and call, okay, your current asset. If you are into cake baking and you've bought your raw materials and things like that, those things are your current assets. But if you are into and if you have oven, you have baking machine and all those things, because you can use them for more than 12 months, which is regarded as the accounting cycle, that makes them your non-current asset. So are we good now? Then we have liabilities as well. So what are liabilities? They are simply what you are owing, what you are legally obligated to repay at a particular period. So there can also be current and non-current as well. Say if you've taken a loan from bank and the loan is for 2 years, 4 years, it becomes a non-current liability, right? You are only recognizing, I'm going deeper now, I'll still come back to the basics for us. So if you've borrowed a loan from bank, say for like 4 years, so it becomes a non-current liability to you. It's the portion you are repaying during that particular period of 12 months that you're recognizing as your current liability. And it's also applicable to the money you owe people as well. So say, for instance, you've borrowed money from someone in church for your business, and you have to repay that person in 3 months. Then it becomes a current asset to you because you are repaying that money within that accounting cycle of 12 months. Please, if you note this morning, that accounting cycle is usually 12 months. You can break your reporting period down to monthly. You can decide to be seeing your monthly financial statements, quarterly financial statements, and things like that. But the general standard or the standard practice is accounting record is usually 12-month cycle, or accounting period is usually 12-month cycle, depending on the period that you want to adopt. So are we good with element of financial statement now? Please take the slides away and let's talk about. Please, next slide, please. Okay, so what are the elements? Okay, I faculty now. Why you? Let's let my participants. Let's my audience. So sorry, sir. Please forgive me. But let's. So yeah, please. Okay, capital. This guy, he will like money. I know he likes to pitch to investors very well. So it's capital that is priority. Okay, so let's go. Yeah. Assets, expense, revenue, equity or capital, and which one again, liability. So those are the things that you need to look out for. In every financial statement, that's what they are communicating. No more, no less. We'll get to how which statement communicates what when they were at the right time. But now, I said something that beyond keeping numbers, it's important to derive insights from your number, right? That's the whole essence. That's how bookkeeping can add value to you. And that's why people run away from bookkeeping. Because when you mention the word bookkeeping or accounting, doing it yourself, the first thing is, first excuse, I'm not a finance person. I have a non-accounting background and things like that. Another thing is people just see it as numbers. But for intentional business owners, right, the essence of keeping your record is to derive insights. And that's another level of accounting, financial planning and analysis, where you're analyzing your information at a more advanced level. To say, okay, what happened during this period and things like that. But at the basics, what's with your revenue information, if you have your numbers, what's your revenue information communicating? One, it helps you to know the peak and the slow season for your business. If you are keeping your revenue number as it should be, right, you can tell the period that you're making more sales and the period that if I ask 5 business owners to sit in front now and to tell me, okay, what period of the year do you make the most sales or do you record the largest sales? People would struggle to give that information. And what it helps you to do is it helps you to plan. You heard Charles Davis saying something like, it helps them to know what they need to scale down, what they need to improve on, and, it helps them to plan as it appropriately. Then it helps you to know the product or services that are most profitable or popular. If you are into businesses where you offer different services or you have different products, take for instance, Auntie Labake sells pie, she sells, what else does she sell for all the customers here? So she sells different products, right? Donuts and things like that. Sister Labake, if Sister Labake keeps record of her sales properly, and I don't want to use the normal business environment, where she gets to look at the trend. Okay, it's donuts that is actually moving the most. Why am I wasting my resources to make pie for people, right? So maybe I should make more of donuts and reduce pie so those are the things that your revenue information does. It helps you to see what you need to do better. Check. So you are paying for adverts, right, on Facebook, Instagram, and all those things. And you discover that most of your sales orders are coming from Instagram. Why are you wasting money on Facebook adverts? You need to measure the impact of Facebook adverts on your business. Should you continue with Facebook adverts, or you should just work with Instagram and spend more, or if you have a budget for advertisement and brand management or something, and spend more on Instagram. So that is what all this, the revenue information, that is what it provides. Helps you to determine, is your pricing strategy actually effective? In the world of inflation, where you can't get to the market today, and you discover that things have, gone, they've added a particular margin to the cost of materials. So is your pricing sustainable? If you continue with this pricing strategy, if you continue with this particular amount, is it sustainable? Will it help you to drive profitability and things like that? So that is what your records, if you have your records, those are the insights that you can derive from keeping all these records. Let's move to the next slide, please. Expense, your cost. It's the same thing, I have a brother in this church, at some point she had to shut down a working store, and she adopted an online store where people can order for stuff and, they pick it. This is what, your numbers, when you look at your numbers, when you stare when you look at your numbers long enough, they start communicating things to you. They start helping you to, your subconscious. It helps you to determine what should you go for. Should you actually keep maintaining this rent? What are you trying to achieve? Or can you do this in a more cost-effective approach? For people that are into catering, should you go to Oniru Market every weekend to buy your raw material, or go to Mile 12 or something and just buy all these raw materials for a month that will last you for a month or 2 months and store them? What is the impact? You can do your cost-benefit analysis. What benefit am I deriving from this cost? That is what your understanding your financial records, that's what they can do for you. Should you outsource? Now, I'll give you an instance. If you run a business where you are into delivery, Ms. Ogude, you mentioned something earlier about offering seamless customer experience, So if you are into business where people need to be calling your rider, hey, I placed an order and they said you'll be here in 17 minutes since 2:30. This is 6:45 and you are not here. You have to be. I'm sure people have experienced that at some point. You're calling the rider and that's a negative feedback on your business. What should you do? Should you continue outsourcing that delivery services? Or if you are a business that you are keen on giving your customer a seamless order experience, should you buy a bike or something? Like Fastest Cake, one of their brand value, right, is to deliver fastest, right? So you can imagine Fastest Cake outsourcing their delivery services. What happens? They are missing out on their key value proposition to their customer. So those are the things. It might not really be convenient at that point for them. But because it's their brand strategy, they will find it. And he said something, what do we need to scale down? So you now look at it. Should we reduce our workforce? What inefficient process do we need to cut down to ensure that we can have more budget for this? That is what your financial records, that is what understanding your financial records, that is what it communicates. Next slide. Now, for the sake of non-accountants, we need to talk about some accounting terminologies because it throws people off balance when they hear you. And that was what I said. Like that person that gave a response of every year when they asked them about their annual turnover, that he or she said, I think he has said every year. It's not as if they don't know what they are talking about. If you tell them what is your income for a particular year, they might be able to respond better. And it's because there are some things that the accounting concepts or terminologies that people struggle with. And that's why we're discussing some of these things. So when you hear the word accounts payable, from the word pay, it means you are owing people. You are obligated to pay them. So if you didn't pay when you're supposed to pay, or if you decide to prolong the payments after you have enjoyed the service, it becomes payable. That's why it's called accounts payable. That is the total sum of money you are owing to suppliers. It could be your staff, it could be your landlord, and it comes from the service that you have enjoyed that you are yet to pay for. That's when it becomes payable. If you pay for a service and when you receive it, it's not payable, right? You have settled that obligation. But when you decide to extend payment after you've gotten that service, it becomes a payable to you. Accounts receivable, the same thing. Say you supplied a company and they are yet to fulfill that obligation to you. It becomes receivable. It has a place where it sits in your financial statements. Okay, so just to provide more context, accounts payable would fall under the liability bucket. So maybe I should be relating them to the 5 elements that we showed earlier. So when you have accounts payable, it becomes a liability to you. So it's you will be recording that under your liability. If you are the type that you are keeping your records yourself, that means for every money you owe, or anything you owe, it's going to your liability records. And for accounts receivable, it becomes an asset to you, depending on when you're expecting the money. If you're expecting the money within 12 months, if it extends beyond 12 months, and in most cases, accounts receivables are usually a current asset, classified under assets, and it's current. Bank reconciliation, it's not really into any category, but it's just an accounting practice that allows you that advocates for periodic bank reconciliation. checking your records with the bank statement. In most cases, you see discrepancy that you need to call your account officer, especially if you are into remittance business. You use POS. I don't know how it works these days, but then I know that in most cases, remittance takes like 24 hours. After you have, is that how it still works now? You don't get all the remittance. No, people get money in their account. That's why they get alert immediately. Okay, so we are making progress now. Before, if you are into POS or all those things, yes, you get a notification that you have received the transaction is successful, but the remittance takes, I think those are the days of flutter waves and the likes. The remittance takes 24 hours before they remit it into your actual bank account, but the money is credited into your wallet. So it's key, it's important for you to do periodic bank reconciliation. Say monthly, yes, monthly is advisable. Pick your bank statement, look at all the cash records you've kept, the money you receive that went to the bank, and reconcile those things. And you don't even have to do all these things now. If your business can afford accounting software that can do all this for you, we'll still get there. Then capital expenditure. When you hear the word capital expenditure, CEO of Western West mentioned something earlier about his sewing machine. The cost or the amount you spent on those equipment, right, that can serve you beyond 12 months, they are what we refer to as capital expenditure. Expenditure. Just name it. You bought a laptop and you use it for, say, 3 years, 4 years. It becomes capital expenditure. You bought an equipment, sewing machine, and things like that. It becomes a capital expenditure to you. And it's usually your asset. It's a non-current asset under the category of non-current assets. Any question so far? Addition? Submission? Next slide, please. You have doubtful debt. No, please go back. So when you hear the word doubtful, what does it communicate? What does it say? It's like something is uncertainty. Thank you. You are not sure if you get it or not. That's what they call doubtful debt. And in most cases, it comes from your account receivable, the money you're expecting from people. A debt becomes doubtful. Oh, okay. I can see the keyword there or something. So a debt becomes doubtful when there is uncertainty about the customer's ability to pay the debt in full. And I cited an example, I think during the last class or something, that you have issues with someone and, someone is owing you, and God forbid, you just said that the person is now in EFCC custody. Yeah, there is even a case right now, one of the lending banks, they lend the account of the customer, hoping that at the expiration of that loan period, the bank would automatically transfer the money to them. But now, the client, the obligor, is now in EFCC. As EFCC case, there is automatic lend on all the customers' bank accounts across board. That debt becomes doubtful if EFCC is taking over the asset of that client. So it becomes a doubtful debt. Then we have operating expenses. This will definitely go under your doubtful debt is a reduction in your assets, because your asset, account receivable is your asset, and when you have a debt that is doubtful, it reduces the amount you should expect from your customers. Then we have operating expenses. There are expenses on the daily and periodic activities that you perform. Just name it. Whatever costs you spend, expenses you incurred on getting things done, they are simply your operating expenses beyond your capital assets now, beyond your non-current asset. I'm talking about the rent you paid, the transportation, the dispatch rider, if you absorb that cost from your customer, and all those things. So salary, staff salary, transportation, rent, and others. Those are your operating expenses. Then you have accrued expenses. Now, accrued expenses is similar to your accounts payable. It's saying that you have incurred, but you've not paid for them. It's recorded under your liabilities. Just like I mentioned, I've given provided more context on the accounts payable. It's accrued. You accrue for it. So if you are living in a building, if you are working in a building, and you know that it's at the year end that you pay your landlord, so you start accruing. Or if your rent is due and you are here to pay your landlord, you start noting it. Okay, every month you're supposed to pay, say, 1.2 million. Automatically, you are paying 100,000 every month. So in your record, you are noting it because it forms part of your expense. Your accounting, your information or your financial information is not accurate if you don't have all this information put together. And I tell you what, based on our time is fast, but I'll just mention this. You know why people don't keep, beyond just understanding this for knowledge sake, why people don't really reckon with bookkeeping and accounting for their business is because some people operate in a sector where they are not regulated or they are not required to prepare financial statements. They only need to prepare financial statements when maybe they need to go to the bank to borrow money, or they need to pitch to an investor, or they just need to put some numbers together, or they want to apply for grants or something. Accountant, a week before you submit your proposal, and ask them to put information together for you. I've worked with different World Bank funded projects, Nigeria electrification projects, growth and employment projects. I've worked with MacArthur Foundation, and when you see people applying for grants and they are submitting their proposal and you decide to analyze their financial statements, discover that they just cook this thing somewhere. Maybe the auditor just cooked this and they just sign it for them, just for them to have a financial information. And I'll provide the context. Say you said your total sales for a year is 20,000, but in your account receivable, you see that people are owing you 50,000. And you have already collected a cash of 30,000. By the time you are doing the ratio and you are doing, sorry, I rushed that because of our time, but I can see Mrs. Oshoko smiling because you understand what I'm talking about. By the time you start doing the financial analysis, how in there will you make a sale of 50,000 and people are owing you 70,000 that particular accounting year, and you have already collected 30,000? Is it that your sales record is not accurate or you have cooked your books? So that's what we're trying to say. That is why it's important to keep your accounting records, because it helps you to know the areas that you need to focus on. It helps you to understand financial terminologies, because it helps you to know, okay, which area should I invest on? Like I said, should I invest in my brand perspection, or my brand promise, or should I invest in expansion and things like that? So let's go into financial statements, and then we ask questions. I would encourage us to, if you have practical business issues that you want to just ask clarifications on, and we'll quickly address it while we can. So, financial statements. When you hear the word financial statement, what comes to mind? Statement, right? That communicates your finance, your financial information. That is what financial statement is all about. And it's mostly into three parts. The statement of financial position, which everybody refers to as balance sheet. When you see your balance sheet, we have the income statement. If you hear the word statement of financial performance, that's also your income statement. And when you hear the word cash flow statement. Now, your statement of financial position, please, can we rush back to that slide where the element of financial statements, please, if it's possible. Your financial statement would communicate. Oh, okay, no, it's fine. Please, hold on, please. It's like, so your financial statement will communicate three things: your assets, your liability, and your equity or capital, whatever you call it. That's what your financial statement of financial position would communicate. You remember we have 5 elements, right? Your statement of financial position communicates 3. Then your statement of financial performance communicates 2, which are your revenue and your expenses. So in your income statement or your statement of financial position, you are simply saying, this is my total revenue for this period, and these are the costs, or these are the expenses. And you see your position, mostly net profits, profits before interest, tax, and depreciation, and all those things, for the purpose of assessing your tax and your performance for that period. Then your statement of financial position, next week we'll analyze them properly, and we can look at how they fit into each other. And your cash flow simply communicates the cash you spend on different activities, your operating activities, the cash you spend in getting things done, your financing activity, the cash you receive in, pitching to investors and things like that. And your operating, investing and financing, investing activity, the cash you spend on getting your item of non-current assets. So those are the key information, but please note this for next class. Before I drop the mic, do we have any question at this point? Or do we have anybody that wants to add something to today's session so far? Do we have questions? I don't like when my people look lost, like it seems as if I've just been talking to myself. I like to engage people, so that's I thank God that Western West was able to at least. So, but I need people from the back. Do you have questions because of our time? People look lost. Okay, what have you gained today, please? Just tell me. Let me start. I won't pick Gideon. Gideon works in the financial services sector. Bro. Oh, you're just coming. Apologies. Okay. I've picked Mrs. Ogundeyi before. Hello, sir. Good morning. Welcome to church. So, you want to? What have you so far in the last 15 minutes or so? So, what have you picked by so far?
Yeah, thank you for the session. Number one, the key message is that it's important to keep our books, right? It's also important to familiarize oneself with financial terminologies. And then number three is that it's not so difficult. So believe in yourself and get it done.
I love that word. It's not so difficult. That's what I should have even said before I started. It's not so difficult. Take your mind off the debit, credit, cost of goods sold, and all those things. You have softwares that can help you achieve all this. You just need to understand why you are doing it, the purpose, why you need to keep your numbers. Beyond CBN, other regulators, FRS, and all those things, chasing you to prepare your accounting information. Why are you doing it? If you want to upscale your business, if you want to derive real insights from your financial data, it's important to keep accurate records. Thank you so much, sir, for that wonderful submission. So I think I'll end on this note today. We'll continue next week. Thank you.